Assalamu alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video we are going to go away from dividend stocks and focus more on high growth companies. Right now the market is down a lot, especially since the beginning of the year, since January 2022. The markets are down 22%. That I'm talking about the S&P 500. The Nasdaq's down quite a bit as well, more than that. Now a lot of the companies that are in the high growth side of things are down 10, 20, 30, almost to 50%, if not more, some of them. So as an investor, sometimes you just need to sit back and think, okay, what companies out there right now are really undervalued that could potentially double my money in the next couple, 5 to 10 years. And that's basically what you need to do as an investor. Yes, if you are a dividend growth investor, then that's absolutely fine. But if you are generally looking for good opportunities that could double your money and so on, this might be a good opportunity. I'm not saying the markets have bottomed and all of that stuff, right? No one knows what's going to happen tomorrow. You can go even another 10% down again. But the point I'm trying to make is, if you are a long-term investor, you need to look for opportunities, this type of opportunities, and then build on that in the next couple of years. What you see right now here is my portfolio. Right now, as you can see, it's 57,400. It's been going up and down in the just last week or so, and it's going to do the same thing over the next, few weeks. So I don't know what's going to happen in the markets, but right now, the earnings report hasn't been bad. So a couple of companies have already reported this week. So Netflix reported last night and was really good. J&J already reported basically a couple of days ago. ASML reported on Wednesday, and Procter & Gamble reported. So ASML and Procter & Gamble actually did really well. Okay, Lam Research reported, I think it was this morning, it was last night. No, it was reported, last night. And it was actually because of that, a lot of the semiconductor companies are actually up quite a bit today, because I think they're up 10%. Let me quickly check. I think they are up 10% today, Lam Research. There you go, almost basically 10% today, because their earnings is really good, and obviously their projections is good for the next whatever. And for that reason, it's actually helping the overall market, especially in the tech companies, especially in the semis. So overall, what I want to do today is talk about 5 great companies that I think that could potentially be a buy in the long run. And also the other thing I want to quickly say is, if you're enjoying this type of content, I don't promote the videos that much, but please like the video, subscribe to the channel, and let me know if you have any questions. I'll try this weekend, inshallah, to answer as many questions as I possibly can. Right, so let's get started. So what are we looking for? We're looking for the company's details. If they have wide economic moat, or if they have a narrow and so on, that means basically, do they have a competitive advantage? We're looking for the current price, current PE, and then forward PE. The difference between it is, current PE, we're looking at basically the trailing 12 months. So we'll take in information from the earnings basically for the last 12 months, right? Whereas forward PE, we're looking for basically looking forward to the next 12 months. So what's going to happen for a year from now? And this is based on projections, analyst projections, whereas this one is something that's already happened. So sometimes the past does not tell us what basically the future holds, but also the future could be unpredictable because it's just using estimation. But I'm going to share with both of them, obviously, right? Profit margins, obviously we know what that is. Operating margins, return on equity is very important, especially for these type of companies. Current ratio, we need to see if the debt levels, okay, is actually too high, if they've got more assets than liabilities, and if they can pay off in the next 12 months their liabilities, if they have to. Free cash flow, obviously, and then total returns the last 10 years. Then basically the expectation in the next 5 years in terms of earnings growth, and then Morningstar valuation, and then we will check the fair prices. Okay. So the first company we're looking at is a company that I'm sure you know about very well. Nvidia, obviously, in semiconductor company, one of the best out there. It has a wide economic moat, and price right now is $125 per share. After the split, when I think it was 120 when they did the split, so it's now coming back down so much. And in fact, when you look at in the last year to date, you can see it's down 58%. At some point, the stock was 174. It came back down to basically right now where it is. I think at one point it was more than that, but hey, look at that. So for a year, 42%, almost 43%. So it's down quite a bit. So, and this is one of the companies that are really doing well in terms of gaming, in terms of the PCs, in terms of not PCs, basically the chips that they develop for PCs. They do an absolutely amazing job. But right now, the valuation seems basically, when you look at this, okay, especially a year to date, down 58%. A lot of that is not just because of the market went down, it's because it was too expensive. And I think people realized it, especially when you have a PE of still 41, considering where the things are right now. Okay, so when you look at current PE is 41, and when you look forward to the basic forward PE is 35 right now. Okay, so profit margin, we're looking at about 26%, operating margins 27%, return on equity 31% almost, current ratio above 1, so normally we're looking for anything above 1. 3.6 is absolutely brilliant. Free cash flow $6.2 billion. They do have some dividend. I think it's very, very small, but it's not even worth mentioning. But they do some dividends, so that definitely covers the dividend, if not more. And total return in the last 10 years, 43%. And this is why this company is so expensive, because people look at that and say, you know what? Obviously, the past is not going to tell us, what might happen in the future. But obviously, the fact that a 43% on total return in the last 10 years, that's absolutely brilliant. And that's why people are paying so much money for this company. And then when you look at the next 5 years, and you realize the analysts are expecting 23% growth every single year in the next 5 years. That's huge. But right now, when you look at it, according to Morningstar, it's 41% discounted right now. And it's only $200 per share. So it's a really interesting company. And again, some people will say, you know what, forget it. I'm willing to take that risk because right now is more expensive than the market and the sector. For that reason, I will take, because it's high risk, high reward. If I can get 23%, would you rather buy Procter & Gamble and just sleep well at night, or buy Nvidia and basically have a little bit of headache here and there, because it can fluctuate very quickly, just like what you've seen in here. Even just looking at just this month, 4% down. Last 6 months is down 41%. So it can go up and down literally 4% every single day. So that's one of the things that you have to really worry about. The next company we're basically looking at is AMD. Very similar company. Again, it's semiconductor. It has a narrow economic mode. $59 per share. I'm really shocked to see even that. When I was doing the research and realized how much this company is right now trading, is ridiculous, because not long ago it was over $100 something. It has a current PE of 24 and forward PE of only 15, which is very interesting. Profit margin of 15.5, operating margins of 16%. Return on equity 10%, current ratio above 1, which is basically 2.4, which is absolutely brilliant. And normally we're looking for anything above 1, so this 2.5, 2.4 is really good. Free cash flow $3.3 billion, on total return of the last 10 years, we're looking at about 35%. Again, that's why people are paying a lot of money. That's why it has a very high PE, okay, in comparison to the market and so on. Growth estimates in the next 5 years, we're looking at about 25%. When we look at AMD, right, let's go in here and type AMD. Okay, and when you look at the stock itself, what you will notice is a year to date is down 60%. A 60% down from, look where it was, $91 per share. And then I think it was January, it was, no, actually in January, yeah, it was $150 per share. That's ridiculous. That's crazy. So it lost, that's absolutely madness, honestly. $150 per share in basically the 3rd of January. Right now we're looking about just less than $60 per share. So it's lost quite a bit, okay? And for that reason, obviously, people have lost quite a bit of money. If you haven't sold it and you still basically have the stock, I'm sure it will bounce back, because if it's 50% discounted according to Morningstar, and their price their target price is $115 per share, that's actually quite, if you own this stock already and you are down quite a bit, honestly, I'll be honest with you, I wouldn't sell it. I'll just keep it. Why would you want to sell it? Because if it goes back, and if what Morningstar is saying is actually true, and it goes to $115 per share, that's way more than what it is right now. So hold on to it, don't sell it, and don't panic sell it. If you own this kind of companies, to sleep well at night, I mean, it's going to be tough, but you know what? It is worth holding on to a great company like that, especially a company who's actually very innovative in the last few years, have actually done better than Intel, right? Next company is one of those crazy companies we've talked about in this basically channel for so long. I used to own it. I at one point majority of my money was in Tesla. I made so much profit, alhamdulillah. I've taken it all out and bought its other companies. To be honest with you, I don't regret it at all, because this is one of the craziest companies out there. I think it's down quite a bit just today. It was down 7% at one point today, I think it was. But right now it's coming back. It looks like about 3-something%. So when we look at the overall current price, $210 per share, 65 PE right now, and forward PE of 51. So it's still very expensive, and profit margins is growing, but it is right now 14% and 15% of operating margins. Return on equity about 30%, and then 1.4 current ratio, and 6.9, almost $7 billion in free cash flow, which is quite nice. Total return about 61%. So if you had it in the last 10 years, well done to you. 61% is absolutely amazing. But guess what? 55% expected to grow in the earnings are expected to grow about 55% every single year. That's ridiculous growth. Fairly valued right now, $250 per share. Right now, you're looking about $210. So it is one of those companies that people, you either hate it or love it, and those are two companies basically. For me, I'm kind of mutual. Like, I love this company, but this stock's too expensive. Okay, but right now, honestly, it's still too expensive. Like, you can't. How could you justify that? I bought it when the stocks were going to the moon. Like, literally everything was going to the moon. So I just basically went along and then sold out when it basically had valuation got too much for me. Okay. Next company we're looking at is Adobe. Is one of the companies that I own in my portfolio, and it has wide economic mode, $304 per share, 30 PE right now. Forward PE we're looking at about 21. 28% profit margin, 35% operating margins. Return on equity almost 34%. Current ratio above 1, which is good. It has $7 billion in the bank, 24% return, total returns in the last 10 years, 14% growth every single year in the next 5 years, and 35% discounted right now. $450 per share is where they are. This company actually reported their earnings just today. I think it was today or yesterday, I can't remember. I haven't kept up with it. I think it was basically yesterday that they reported, and I think it was fine. They've actually they just lowered their guidance, but no, actually they kept it. I think they kept it. Let me double check. Yeah, there you go. They reported on the 18th, and it jumped after they've actually had a strong guidance for the year. But yeah, so that is one of the companies. And right now, in fact, let's just go back to quickly Tesla to show you where the stock was a year to date. So, and that is ridiculous, 47%. And I'm not surprised, I'll be honest with you. Out of all the companies, I expected that basically from Tesla. Adobe, okay, let's see where it was a year. Okay, 46%. So very, very similar again to the rest of the companies that we're looking at. And right now, $240 per share is basically the expected. 300 is basically where it's at. I own it. I own it in my portfolio. Is one of the only companies that I own in this list here today. And it's a great company. I actually genuinely wish I could buy more right now. I had the gas to buy more, but I'm a little bit holding back because the volatility in the market and so on, it could potentially go down lower. And I'm seeing other opportunities with dividend companies. So that's the only reason I'm not adding to it yet. Okay. And finally, the final company we're going to talk about is one that's not basically that doesn't have a positive earnings yet. And that's CrowdStrike. And honestly, out of all these companies, this is the one I am looking forward to some point basically having it in my portfolio, either this portfolio or the family portfolio, because I genuinely believe in this company will be one of the biggest companies out there in the long run when it comes to cybersecurity. Currently trading $156 per share. No PE, obviously, but forward PE 113. Not bad, because at least we will have some sort of a positive earnings. That's what it means, right? Profit margin non-existent. Operating margins again is the negative. Return on equity is still on the negative. Current ratio is absolutely fine, so they don't have any problems with their liabilities and so on. Free cash flow in the millions, so now 542 million, so that's absolutely fine. Total return in the last 5 years, not 10 years, because the company only started not long ago. It's about 18%. Growth in terms of next 5 years, 74% every single year. That is huge. That is mad. If they can grow their earnings to 74%, but 74% from almost zero, literally from in the negatives. So 23% you discounted right now, 196% expected to be in terms of the price wise, according to Morningstar. So there you have it. 5 different companies, all in the technology sector. Great companies. Also, majority of them have a positive earnings, apart from this one here. But this is the reason why people are paying a lot of money. This is the reason why people are paying a lot of money. You're paying higher multiples because of the growth. Because basically it's a high risk, high reward situation. Okay, so this is the type of company. I would say to you, if you are new to investing, you would want to own maybe 1 or 2% of this type of companies, not a portfolio just full of these companies, unless your risk tolerance is higher than mine, right? Genuinely, maybe owning 2-3 companies of these type of companies, right, stocks, then you'll be fine. But if you say a portfolio of these companies, honestly, you're just gonna have a headache, especially the way things are. When everything was going to the moon, this was the companies to own. Everybody talked about it. Right now, is there anyone out there talking about them? Absolutely no. And look where they are right now. So what I'm saying is there might be an opportunity in this field. It might be an opportunity within technology sector, because they have been absolutely beaten down so much. So if you are new to investing, maybe do your research on some of these companies, and then slowly just nibble, just buy a little bit here and there. Don't put hundreds or thousands of pounds, right? Just buy a little bit here and there whenever you can. Whenever you see a red day, just buy whatever you can. Again, that's not financial advice. That's what I would have done. That's what I'm doing with my own portfolio. I'm dollar cost averaging every single month. Okay, if you are still here, you're enjoying the videos, I would love you to give the video a like, subscribe to the channel. Let me know if you have any questions. There will be more videos inshallah in the next couple of days, and then over the weekend I will definitely be doing another video inshallah. Have a wonderful day. Assalamu alaikum.